In this video, I'm going to tell you the UK stocks to buy that would benefit from a Brexit negotiation resulting in a trade deal. Disclaimer, I'm not a financial advisor, and if you seek financial advice, please seek a licensed professional. Please also remember that this is my opinion and I'm merely speculating on what the outcome of Brexit would be like. So what could we expect to happen with a deal with the EU? Well, there could possibly be thousands of different individual deals. However, I'm going to speculate amongst the biggest ideas. Firstly, I believe that sterling will rally up, as currently right now it's priced in. There's a lot of uncertainty and therefore sterling is at a very low point compared to that of the dollar and the euro. With this in mind, I feel that if the pound rises, there'll be cheaper imports to the country, and also the fact that if we're able to negotiate a trade deal with the EU, therefore it'd be subsequently even cheaper and faster process as well. So therefore I think the companies in the UK will be able to get stuff into the UK a lot quicker and for a cheaper price. The companies that are growing in Europe would have likely slowed down recently over the uncertainty around Brexit. So these UK companies could likely gain a further boost if there are terms put in place that could perhaps speed up the process, such as not having to make applications for certain minute processes in the EU and slowing down their growth potential, as these legislative processes could take a lot of time and money, and in this situation, time is money. The first stock that I feel that would benefit the most from this is a house builder, as they've undergone a lot of pricing in the stock markets, and with the uncertainty around the Brexit negotiations, this has only made the share prices struggle more. However, in 2019, a lot of them had rallied as the uncertainty had worn off. However, with the idea that it could be looming by the end of the year, I can understand why it's now being repriced in along with the pandemic. And upon the success of a trade deal, it's very likely we could see these specific stocks rallying. My choice of a house builder is Redrow. I think they will benefit one of the most from this. I consider them to be the most undervalued house builder, and this is backed up by their price to earnings ratio, in which they have a 5.3 times, which is lower than the industry of 9.8 times and subsequently the market of 15.2 times. This would also suggest though that investor sentiment is lower, and this could mean that perhaps people are less confident on this stock's ability to outperform the market in future and therefore less likely to put money into it. However, if we see a shift and perhaps people are like, actually, yes, I like this company, then this could have great growth potential. Should Redrow resume the dividend, it only supports this fact even more. If that is resumed at its current price, it would have a yield of around 6.6%, which is higher than a lot of companies listed in the FTSE 350, and they typically pay in April and November each and every year. However, we would have to wait until September to find out more information on this topic, as that is when they typically declare their second dividend for the year. They did have a payout ratio of 34%, which puts them in an excellent position, as it means they are more than adequately able to grow their dividend in future and also reinvest profits back into the company, where they could likely build more houses and expand out further in the UK. However, the dividend history has been very unstable. Whilst in the last 5 years they'd managed to grow their dividend by a compound annual growth rate of 38%. This was also seen by the fact that they had cut their dividend in 2009 until 2013. At the current share price of around 460 pence per share, I do feel that this is fair value currently, although I do see it at a significant discount compared to its February highs of around 860 pence. So yes, there is a lot of upside potential with this, but we should also consider the fact that since 2007, it would have taken them 10 years to fully recover that share price. And whilst this looks like, yes, there's an excellent chance for 100%, 200% returns, it may take a long time. However, if you'd have bought in 2008, you would likely be sitting on around 300 to 400% gains. So it is relative. If you'd bought into Redrow before the pandemic crash, then perhaps you've got a lot less upside than that of after the pandemic crash. And that should really dictate whether you should continue to hold this investment, buy more, or cut your losses and sell. And if you'd have bought this company 5 years ago, you would have seen returns of 21.8%, beats the market of 19.8%, but loses to the industry of 30.5% with dividends reinvested. However, I do feel that IT companies would benefit a lot from the Brexit negotiations and subsequently a trade deal, as businesses are more likely going to be relying on technology in the future. And this is furthermore compounded by the idea of UK financial technology growth. Softcat are a value-added IT consultant company that adds value to as an IT reseller and IT infrastructure provider in the UK. As domestic companies in the UK would likely benefit from a rise in the pound as they have more spending power, this could lead to a lot of them adjusting their strategy and likely investing money from their business into technology and updating their systems. And this is where I feel Softcat would be in such an excellent position to benefit from this. Currently, they have a dividend yield of 0.89%, and this was due to suspending it due to the pandemic virus, which I think was fair, reasonable. And whilst they do have a large cash position, it was a more defensive play as it's very uncertain around the virus and its impacts. Whilst they've had a great dividend history since being floated in 2015, it is short and limited, therefore you can't guarantee that this growth will continue to rally. And because of this, I would mainly purchase this stock for its growth aspects rather than that of its dividend potential. SCT have managed to grow their earnings on average by 22.4% in the last 5 years, which nearly doubles the market average of 12.9%. They also have extremely impressive returns of 75.9%, which is outstanding and completely outperforms the industry of 16.4%. However, typically high debt loads do skew this metric, and therefore you would assume that, well, perhaps they've got a high debt load and that's why it is quite high. Well, in fact, Softcat actually have zero debt, which is quite incredible for a company. And they are also in a fantastic financial position in which their short-term assets outweigh their short-term liabilities and their long-term liabilities combined. Softcat have also generated a return on assets of 20%, once more beating its industry of 8.2%. If we could see these statistics added to the share price or reflected somewhat in the share price of this stock, then it's likely got a lot of growth potential for the future. In fact, if you'd have owned this stock in the last 3 years, as 5 years isn't available, with dividends reinvested, you would have seen returns of 234.9%, not only beating its market of minus 2.4%, but also the industry of 69.6%. Softcat are a fantastically well-managed company, and no doubt, I believe that they will continue to grow in the future, and that regardless of the outcome of Brexit, they will continue to generate these impressive returns. But they will benefit more from a deal, and currently their share prices fluctuated between around £10 per share and £12 per share, and I think this is fantastic value for such an incredible company, despite its price earnings ratio of 31.6 times. 40% of you watching this video right now aren't subscribed, so if you're interested in my portfolio updates, stock picks and analysis, then please consider subscribing, as it is after all free. Thank you. If the UK manages to negotiate a trade deal with the EU, then I could possibly speculate the idea of tourism starting to increase. Once the pandemic virus has dissipated, I suspect that if EU citizens are able to travel into the UK, that they likely would. And therefore I can see an increased demand in that of sports games, as things like the football leagues are very popular amongst Europeans. And so I could see it quite likely that the EU citizens could travel over to watch a Premier League game. And this is where the next company benefits, as they are a sports betting online and in stores. And I also feel that disposable income could potentially increase in the future, gaining in popularity if EU citizens are able to get into the UK for cheaper and with less hassle. Then I see that the demand only furthermore goes up. And therefore I feel that William Hill could benefit a lot from this situation. However, this is the highest risk stock on the list, as they are currently unprofitable and restructuring the business to maintain cash flow. I suspect that they've lost a majority of their income during the pandemic, as sports were suspended for 3 to 4 months during the lockdown period. This is also followed on by the idea that in 2018 they had a large financial loss of 722 million. And this is due to regulatory changes on fixed bet offerings, and therefore meant that they were less profitable during that period. And this had led to negative profit margins, and this isn't a great sign to see. Although realistically, I feel that they could never have predicted or anticipated for this situation, and therefore management-wise, I do not believe they are at fault for this. However, with this in mind, they do have a fairly weak balance sheet and financial position in which their short-term assets don't outweigh their short-term liabilities or their long-term liabilities. And this will likely lead to the further dilution of the shares, which they'd already done this year by 20.2%, significantly increasing the amount of the share pool and subsequently reducing your stake if you were an investor in the company, therefore subsequently dropping the share price. This has also led to an increase in debt to equity, as their equity position has fallen, and therefore over the last 5 years their debt to equity ratio has increased by 219%, This makes this stock extremely risky. However, their debt is covered by their cash flow of around 20%, but this still could be an issue. I don't feel that this is a typically standard growth stock, as their earnings have remained fairly flat. However, I do believe that they can become once more profitable as they start to sell their stores and focus more on an online betting and casino business. But I do believe they have a high chance of growth potential in the exposure to the United States market, in which they're starting to relax some of the regulations and legislations around sports betting, and therefore could lead to William Hill benefiting a lot if they are adequately positioned to deal with this. I personally believe this to be a speculative play around that of Brexit. And if they are successful in restructuring and do expose themselves to the US market furthermore, then I do believe that they could generate some very impressive returns. And Brexit will likely increase the demand for sports events in the UK, as more EU citizens may start to watch the games live and therefore benefit the sports betting industry. If you've gained value from the video so far, please drop me one of these, as it greatly supports the channel and the algorithm. Once more, I'm confident in the potential of property markets in the long term, and I've already spoken about house builders, but I'd like to go further into this. Combining with the idea that some Hong Kong citizens will be seeking residency in the UK, the housing demand feels like it can only go up. And a company well positioned to deal with this is Rightmove, as they will benefit from the increased housing sales and purchases, as well as leasing. So the more tenants there are going through their website, the more they can obtain in fees and costs. Since Rightmove is a software company, they have low operating expenses, and therefore can generate extremely impressive profit margins of around 60%. They would also see a benefit in the increased spending power of the pound, and currently, since they are only based in the UK, they could diversify, with this pound being able to acquire American assets for cheaper, European assets for cheaper, and therefore, if the pound does rally, they could expand out globally. Very similar to that of Zoopla, a United States company in the same niche, and therefore I do see a lot of high growth potential. And historically, they have managed to grow their earnings over the last 5 years by 11.5%. Whilst this could be considered fairly slow compared to other companies, the idea that this is boring and potentially consistent is what I like, and therefore makes it a more defensive stock to add. RMV is currently trading at a fair premium 30.1 times, which is under just double of the market of 15.2 times. But they are a lower premium than that of their industry of 39 times, which suggests whilst yes, they are overvalued considered to the market, they are undervalued compared to the industry. Investor sentiment could be lower in this stock, and this could be due to the fact that they are very exposed to economic cycles and they don't have a big moat. As they are exposed to the economic cycles and at the mercy of the property market, if we see a property market crash, they're going to see less sales and therefore their revenue is going to drop. If, however, it booms and it all does well, then they're going to see increased earnings potential. So it's a very cyclical potential stock. Also, whilst they currently have 85% of the market share, they don't really have a moat or anything to really protect them from other companies coming in and taking their business. And Zoopla, as of late, have been offering real estate agents that list the properties on this website, they've been offering them reductions in fees so that they would swap from Rightmove to Zoopla. And therefore, unless Zoopla takes some radical actions, this could impact the company. This is also supported by the idea that they've had to cut their fees by 75%, which subsequently means that their revenue has dropped by 75% due to the pandemic crisis. And this could stay like this in future, as they have to price cut in order to compete with Zoopla, and therefore meaning that their earnings potential is going to be a lot less and they could be making a lot less money. But they can generate very, very strong returns, such as a return on equity of 418% and a return on assets of 176.5%, which it's not even worth comparing to the industry, as they've got single digit and a 10.3% compared on the return of equity. I will note, however, they do have an impressive dividend history, and since they've only paid since 2006, they've managed to consistently pay each and every year. They didn't grow it in 2006 and 2007, however, they did cut it or suspend it due to the pandemic situation. But prior to that, they'd been growing it at quite a fast rate. And in fact, in the last 10 years, you would have seen a compound annual growth rate of the dividend of 10.84%. But this also takes into account that the previous dividend payment wasn't paid, and therefore it's a cut of minus 56.92%. And that's still such an impressive growth rate that beats inflation, or the target for inflation by the Bank of England, by 5 times. If they're able to resume this, then their dividend growth could keep going up. They are in a great, strong financial position, but there is concerns that competition could move in and take their income. So it really depends on the company, and therefore I think that that is currently priced in, as you could see their share price fluctuating around 500 pence per share. In the last 5 years, they've managed to generate shareholder returns of 84%, beating the market of 19.8% with dividends reinvested. I think that it has a lot of potential to do better than this. And currently, because of the Brexit negotiations and the worries about the property market, especially combined with the pandemic situation, that it is priced under severely. But I do also believe that at its current share price, it could also be quite risky to purchase. The next company distributes and manufactures miniature retail figures and also earns an income throughout selling royalties of using the brand Warhammer in filmmaking and gaming industries. GAW are in an excellent position to benefit from an EU-UK trade deal, as they currently import-export goods across the globe. This also allows them to acquire more assets such as stores, as the pound will likely rally in value, therefore giving them more purchase power. However, they likely earn income in multiple currencies, and so they're not earning in just pounds, which can affect them negatively. But I do believe that the UK still makes up a majority of their income currently, and this will benefit them when looking to expand into the US, EU, or Asia. And it currently trades at a price to earnings ratio of 34%, which is a significant premium to its industry of 14.8 times and also the market of 15.2 times. But then they've also generated significant returns on equity, like 66.6%. And therefore I do feel it's fair that it is traded at a premium, because this company has continued to generate strong earnings growth, such as in the last 5 years, they've managed to grow their earnings by 42.8% on average, which is incredible growth for a company that distributes and retails products, miniature figurines, and in which, compared to its industry of 16.3%, it is in a very strong position. And if you'd have bought this stock in the last 5 years, you would have seen returns of 1,977.8% with dividends reinvested, which is incredible growth. And I've spoken about this before on the channel, but the idea is that even if that's 10 times worse, you're still going to be outperforming the market by such a considerable amount. They also pay a quarterly dividend, which yields only around 1.7%, but they have managed to grow their dividend very well in the last 10 years. And in fact, in the last 10 years, they've grown it by a compound annual growth rate of 19.22%. At the same time, also boasts an incredibly reasonable payout ratio of 50.5%, allowing them to continue generating earnings and growing their dividend in future, as well as using some of the earnings to continue growing the company across the globe. They currently trade between around £80 per share and £88 per share. I still think this is fair value, but my strategy is to buy on every weakness. And so if it's trading at £85, drops to 82, that's a weakness, and I think it is fair value to buy, as I think this company is going to continue to grow, and it has a very high investor sentiment and following behind it. If you're interested in my UK stock portfolio journey and want to watch from episode 1, then please click the card at the top right of the video. Thank you for watching. I'm Osborne Foreman. Have a great weekend.